In the last video, we discussed about what in-the-money options are and what out-of-the-money options are. In this video, I want to go over which strike prices to pick, but without understanding the options Greek, that would be the waste of my time, and that would be a waste of your time as a beginner because it wouldn't make sense. So down the line, we're going to first talk about option Greeks first, and then we will proceed towards when to use in-the-money strike prices and when to use out-of-the-money strike prices. So without further ado, let's get started. Alright, before we get into delta, theta, vega, etc., let's just start with this. What the hell are Greeks in option trading? Think of it like this. Let's go back to our car analogy which we used in our previous video. When you buy a car, you just don't look at the price. You check the fuel efficiency, the safety rating, the horsepower, and maybe even the insurance cost, because all of those tell you how that car will perform after you buy it. Options are the same. The Greeks are like the performance stats of an option. They don't just tell you how much it costs, they tell you how much the option will behave while you're holding it. Will it move fast when the stock price moves? That's delta. Will it lose value every day? That's theta. Does it get more expensive in wild markets? That's vega. If you don't understand the Greeks, you're basically buying a car with no clue how it drives. So let's break it down simply, clearly, and from a buyer's point of view. Now let's start with delta. Delta tells you two things. One, how much your options will move when the stock price moves. This is the most direct part. If stock goes up $1, delta tells you how much your option will gain in dollar terms. Think of delta like a car's acceleration. If you tap the gas, how much does your car move forward? A higher delta option is like a car with a strong engine. You tap the gas and it responds fast. A lower delta option is like a car with weak acceleration. You hit the gas, but it barely moves. If the stock goes up and your option barely moves, that is a low delta option. If it surges forward with the stock, that's high delta. Here's how the delta connects to our previous video. The more in the money your options are, the higher the delta. The more out of the money your options are, lower the delta. That means the in the money options move like the stock. They are responsive. They've got stronger engine. Out of the money options are lighter, cheaper, and riskier. They only move if the stock makes a big push. So now number two, how much your options behaves like the stock itself. Higher delta options behave more like the stock itself. For example, if the stock gains $2, your options might gain somewhere around $130 or more. Lower delta options typically lag behind. They might only gain $40 or $50 for the same amount of move. Imagine your option as a car driving alongside the stock. The higher delta option is in the same lane, going almost at the same speed. A lower delta option is way behind in a slower lane trying to catch up, but only if the stock speeds up a lot. If you want an option that tracks slowly with the stock price, like a reliable co-driver, you go with the higher delta options. So delta isn't just about the price, it's about how your options behave while the stock moves. It tells you, is this thing going to move when I need it to? Or is it going to sit there unless the stock explodes? And just like in a car, if you care more about the response time and control, delta is your spec sheet. Great, now let's get into practical applications. What delta should I look for depending on how long I plan to hold the option? Let's break it down into three real time frames. When you're trading shorter term or intraday or day trading you call it, ideal delta to look for is 0.70 to 0.85, which is deep or solid in the money option, because you need the option to move quickly and tightly with the stock. You're not holding overnight, so you don't care as much about the premium. You care about the speed and precision. These options act mostly like the stock, fast in and fast out. Less theta burn because you're not holding it long, and the delta above 0.70 has much higher correlation with the dollar for dollar movement, often gaining more than 70 to 90% of the stock's move. So if you're medium term, if you're swing trading, that is several days or to 2 weeks time, ideal delta to look for is 0.50 or 0.65, ideally in the money or at the money strike prices, because you want the balance of decent movement with the stock price, manageable cost, and not getting wrecked by the time decay too quickly. Options in this delta range offer a solid mix of sensitivity towards gamma and slower decay. They're popular for earnings, breakout setups, or catalyst trades. Now, if you're looking for a longer term trade or positioning trades, which is ideally for more than a month, the ideal delta should be 0.30 to 0.50, slightly out of the money or at the money options. You're targeting a bigger move over time, so you're okay with a lower delta now, expecting it to grow as the trade matures. Typically, traders choose this because it's cheaper to enter, gives you more upside if the stock trends, but you must be right on direction and timing. Out of the money options with low delta will lose money slowly at first, but if they move in the money over time, the delta increases as they gain momentum. So think of delta like a gear shift. Higher delta means tight control and quick reaction. Mid delta usually means balanced drive, and low delta refers to slower start but high reward if the road opens up. So to summarize, if you're trading for shorter term, especially intraday trading or day trading or scalping, whatever you want to call it, go for 0.70 to 0.90 delta, because if you're gamma scalping, you need quicker moves, faster moves, and you need the option to move with the stock price. So deep in the money options are better suited for those types of scenarios. If you're swing trading, which is holding for 2 or 3 days to more than a week, well, a delta with 0.50 to 0.70 works perfectly fine. And if you're holding something for longer term, especially more than a month, like 2 months, 3 months, 4 months down the line, 0.30 to 0.50 works good. Hope this offered a decent explanation for delta. In the next video, we'll talk about theta and how the time decay affects your options down the line, and how the theta impacts in the money options as well as the out of the money options as well. Thank you so much for tuning in, really appreciate it. And if you want to trade live or if you want to join the Patreon, the links are down below in the description. Feel free to check out. As always, take high probability trades, manage the risk wisely. I will see you guys in the next video. Bye-bye.